Let's talk about this so-called starter home. For generations, it was the first step on the ladder to success. But today, we're going to pull back the curtain and show you why, for so many people, that first step is actually into a financial death trap that can derail your life for decades. And I'm going to make you a promise right now. I'm going to show you the actual math, the numbers that the real estate agents and the banks kind of hope you don't look at too closely. The whole point here is to see past the sales pitch and understand what you're really signing up for. So what even is a starter home anymore? You really need to forget that image of the cute little cottage your parents bought for a song. The new reality, the new baseline, it's a whole different beast. Yeah, that's the number. $500,000. And that's often the price for a pretty modest, maybe 1,200 square foot house that probably needs some work. Now, put that into perspective. The median household income is floating around $84,000 a year. So we're telling people to buy a house that costs almost 6 times their entire yearly income. If that sounds completely insane to you, well, it's because it is. And let's be totally honest about what you get for that $500,000, right? Is that charming fixer-upper you've been eyeing just a nice way of saying it needs a new roof, new plumbing, and still has that questionable beige carpet from the early 2000s? This question really gets to the heart of it. What kind of value are you actually getting? Okay, so this brings us to the first giant myth we need to bust, and that's the down payment trap. It's this idea that you just have to get your foot in the door no matter what it takes. But that pressure to just get in the market can lead you to make some seriously dangerous financial moves. Take a look at this. It shows the enormous gap between the dream and the reality. For that $500,000 house, the dream is putting down 20% to avoid extra fees. That's $100,000 in cash. But the reality, well, the median American savings account has about $8,000 in it. That's not a gap, my friends. That is a canyon. So how do people possibly bridge that canyon? They get hit with this thing, PMI, or private mortgage insurance. And let's just call it what it is. It's a fine. It's a penalty you pay every single month for not having a spare $100,000 lying around. And you have to understand, this insurance offers you exactly zero protection. It's there to protect the bank in case you can't pay. That's it. Which leads us to this crucial point. The bank is not your friend. They're not your financial advisor. Their business model depends on you borrowing the absolute maximum amount of money possible, because the more you borrow, the more interest they collect for the next 30 years. Their incentives are not aligned with yours, period. All right, let's get into the second myth, because this one trips up almost everybody. You think your housing cost is just your mortgage payment, right? The principal and interest? But oh no, that is just the cover charge. That's just the beginning of what you're really going to be paying. This chart really breaks it down. Your actual mortgage payment, the P&I, might only be about 60% of what you're on the hook for each month. The other 40%, is this cocktail of property taxes, homeowners insurance, and the one that everyone forgets, maintenance. So what does maintenance actually look like in real dollars? Well, there's a good rule of thumb called the 1% rule. It says you should plan to spend about 1% of your home's value on repairs and upkeep every year. On a $500,000 house, that's $5,000 a year, which comes out to $417 every single month that you need to be putting aside for when, not if, the water heater decides to give up the ghost. And now, this is where it all comes together. This is our final myth, and it's all about the terrifying gap between what a bank says you can afford and what you can actually live on without feeling like you're drowning. Let's use a real-world example to see how this plays out. Let's meet the Johnsons. On paper, these guys are crushing it. Dual income, making a combined $160,000 a year. Awesome, right? They get approved for that $500,000 starter home, they buy it, they move in. But once the dust settles and they run the real numbers, they realize their total housing cost is eating up a jaw-dropping 46% of their monthly take-home pay. And this chart just shows you the brutal reality of that. Almost half of their income is gone. Poof! Before they've bought a single gallon of milk, paid for daycare, put gas in the car, or, and this is a big one, saved a single penny for retirement. This is the definition of being house poor. You have the house, but you have no life. And that's really what it comes down to, isn't it? Being house poor forces you into these impossible daily choices. You're constantly weighing the dream of having that nice kitchen against the reality of being able to pay for your kid's school trip without having a full-blown panic attack. That's the hidden emotional price tag. So why does this happen? Look at this comparison. Banks will happily approve a loan that pushes your debt-to-income ratio all the way up to 43%. But for decades, good financial advice has said your housing costs should be no more than 28% of your gross income. One is basically a financial stress simulator. The other creates actual margin and freedom in your life. So, if you only take one single thing away from all of this, please let it be this right here. Just because a bank is willing to give you the money, it does not, under any circumstances, mean you can actually afford the life that comes with paying it back. So, what do? Is it hopeless? No, absolutely not. This isn't about giving up on your dreams. It's about changing the goal. It's about shifting your focus from just owning a home at any cost to achieving financial well-being above all else. I love this quote because it's so empowering. Sometimes the smartest, most strategic thing you can do is look at the current game and realize it's rigged against you, and then choose to play a different game. Choosing to rent strategically isn't losing. It's a calculated move to give yourself financial margin, the freedom to invest, to save, to live without that crushing weight on your shoulders. And so that's the final question I want to leave you with. Really think about it. When you sit down at that closing table and see that mountain of paperwork, are you buying the American dream? Or are you signing up for a 30-year prison sentence where your job exists only to pay for a house that prevents you from living the life you actually want? It's a heavy question, but it's one you have to ask.